From Barangaroo Studios, this is the COB, brought to you by eToro. Invest in ASX shares with $0 commission.
Good afternoon, this is the COB, everything you need to know in the day of, well, business and markets. My name's Kyle Rodder and I'm with my co-host, Danny Akuye.
Absolutely.
A bit of a drift lower into the back end of the session, Danny.
Absolutely. I'm just trying to quickly reload my computer. Oh, there we go. The CIBO 200 down 0.3%. And yeah, it was really interesting though, because it might be what we're going to touch on in terms of themes, but it was a tale of different sectors, wasn't it, performing? Some hefty profit taking in some, and then some other sectors doing quite well.
Yeah, well, let's crack onto that because, well, the three themes is more or less touching on the fact that tech has led that weakness, and it seems to be that little AI trade has faded in the short term. I mean, momentum, again, we're talking very much in the short term, can sometimes take hold of markets, and you know these things just run a little further in the short term than perhaps is fundamentally justified. So, I mean, maybe we're just seeing some of the heat coming out of that particular trade, because it has run up remarkably.
Yeah, and what was interesting, the Fed, I think, has come out and said they're going to have to raise about 430 billion around that to fill the coffers in quite a short space of time, and that will certainly drain some of the liquidity out of the system. Of course, where is it going to drain from? Well, not only the outperformers, but where all the money went and the longer dated assets, etc. And yields are moving up across the globe, so that also too is not good for longer dated assets like technology.
Yeah, and healthcare was weaker too on the basis of that. I wanted to move the conversation just to, well, recession ahead potentially. We've been talking about it more and more in the last few days. We're getting a lot of, I suppose, street analysts, economists, CBA in particular, talking about, well, rationing high their expectations for the cash rate this year, and CBA forecasting that there's they call it a 50-50 chance of a recession by the end of the year, which is a pretty stark warning, it has to be said. And well, that's being reflected again. We're talking about these sectoral themes in consumer discretionary, in particular the retailers, those smaller retailers as well. Absolutely,
and I'm really not that shocked that they are starting to say that. We did see the 2-year bonds starting to invert here in Australia, just a wee bit.
That rarely happens in Australia too, mind you.
Yeah, it hasn't happened since 2008. And as we mentioned yesterday, we keep on, hearing things of, days past when economic
tales of woe.
Economic times weren't good. And I've had a couple of property people on today, and the most important thing that as these rates go up and the mortgages go up, we're really reaching that 30% of your income that gets paid out in your living costs, your mortgage or your rentals, and that really means on the top of all those other higher costs, heating, all of that stuff, higher food prices, the consumer has to shut their wallet to everything else. And it's something that we really haven't seen for quite a long time across the globe.
Indeed, and well, of course, we'll be keeping an eye on that as that sort of thing unfolds. Last thing I just want to say, we did have another rate rise surprise last night. The Bank of Canada lifting by 25 basis points. And well, I mean, I know I heard you talking about it a lot today with some of your interviews, that the central banks are taking, well, they're playing the tough guy. Feeling like they needed to play the tough guy to obviously not make sure that things don't get out of control here.
Yeah, absolutely. So that's up to a 22-year high, the Bank of Canada. And not unlike Australia, their property prices have been really firm, and I think that's been very much worrying the bank over there, Bank of Canada. I think it's like literally, I think panic for central bankers is the wrong word, but they are, I think, very concerned that they do not want, nobody wants a rerun of the 70s.
No.
Yeah, and that's kind of where, some people are saying if inflation gets embedded, etc.
Music was pretty good though.
Yeah, fashion got better towards the end of it.
Yeah. Have you still got some of that? Can you wear it in one Friday? Bell bottoms or something like that?
No, I'm the disco queen.
Okay. All right. Well, we'll save Saturday Night Fever to another day, but perhaps weekend. But let's have a look at the sectors of the market. And, well, we've already more or less touched on that. Xero has had a remarkable run up, it has to be said. And
so is WiseTech.
And WiseTech too, off by 3.2%. So this would be pretty typical profit taking, I guess you could call it. But still, some of those themes you were talking about before driving price action.
Yeah, and probably the movement in yields is driving Computershare at the moment because they're a direct beneficiary of higher rates.
Yeah, move I suppose in line with that, rather unlike the rest of the tech space. Retailers, let's see the pain here.
Yeah,
pretty broad base. Lavisa as well, just can't catch a break.
Yeah, I mean, really, that one, which has been a darling of the stock market and has done terribly, terribly well, but it's a bit like someone's punctured the tyre on the Lavisa share price at the moment. But, still a good quality company. I had two guests today talking about these retailers, both of them saying, do you get your shopping list ready? Here's what you can watch it with Roger Montgomery and Luke from Merriweather, just talking about what to look for, strong balance sheets, how to set the dial of when you see these share prices wash out, because there will be some great buying over the next few months.
Interesting. Okay, so literally create your shopping list for some of these retailers. But miners now actually saw some strength through there today. And there you have BHP, Rio and Fortescue all up. The energy plays were actually stronger today across the board. There was a bigger than expected drawdown in US inventories last night. In fact, it was expected to be a build. So I don't know if it was exactly to do with that, but at least there was an impetus there potentially for a jump. The coal plays also were significantly higher. Yeah,
so just chatting with a China expert, and the fundamentals still remain pretty dire in terms of steel demand, and the property developers are not doing the property development. So it's expectations. It's almost like the markets are trying to push Beijing into a big stimulus package there. And you are seeing a rally in some of those iron ore prices, but the overall fundamental view is still quite bearish for the steel markets and the iron ore markets.
Yeah, they just really haven't stepped in and filled that hole, it would seem, in global demand, at least for now.
It's more the narrative, let's get bullish, that's overriding, the fundamentals.
Okay. Well, we did speak a lot about the retailers today, and we did mention before Premier Investments. In fact, it was our stock of the day. Ben Clark and Francesco Destratus gave their view on Premier Investments.
That's a store every day, going from the station to the office, and that store's gone. So I struggle to see them sort of picking things up in the next 12 to 18 months. So yes, look, they are good retailers, and ultimately longer term, there's probably better things on the horizon for them. But I think there's probably a little bit more pain before any positive turnaround for them.
If Premier does downgrade, it won't be right with Premier either. I think Smiggle, which is the crown jewel in Premier Investments, is under like that. You would be worried, I reckon, because when you think about Smiggle, the demographic is young families.
Yeah, no one wants to touch anything with consumer on it at the moment, for better or worse.
Yep.
All right, wait for another day perhaps, and like you said, get that shopping list ready. But let's get a kind of global view now of things, because Craig Ellen from Oanda is standing by. He's live from London. Craig, great to see you once again. It's been a while, so it's fantastic to have your company. Just wanted to talk about the overnight price action on Wall Street and what seems to be coming through here in Asia too. Maybe just some of that excitement of the AI trade, I guess, disappearing a little bit, and while we're just seeing some profit taking come through the market.
Yeah, I think people have been really spooked by what we've seen from the RBA and the Bank of Canada, be quite honest. These are two central banks, one of which had paused for a number of months, the other of which was expected to pause for a few months. And both of them have surprised the markets and raised interest rates. And all of a sudden, we don't really view central banks, it seems, at this point in time individually. It's a collective thing. And therefore, when you see the RBA and the Bank of Canada both raising rates, then the question starts to be asked, well, who else is going to raise rates further than we expect? Is the Fed going to pause next week, or are we going to see more rate hikes from them? We've already seen many more rate hikes priced in for the Bank of England. And the ECB, the markets were pricing in one, maybe two. Is that too optimistic? And that seems to be where we are right now. There's been a lot of optimism in the markets that we are going to see price pressures subside over the summer, and that central banks will be given the freedom to pause. And in reality, are we seeing inflation more sticky? Do they have to keep raising rates? Will they have to remain high for longer? because the reason why this is so important is because rates have now risen to a point where we're kind of at the pressure point where we could really see the pain in the economy as a result of rates rising as far as they have and staying there for much longer. And I think, like I said, the RBA, the Bank of Canada has spooked the markets. What we kind of need now, if we want to see a bit of more positive sentiment return to the markets, is for the Fed next week to pause. But I'm not really necessarily convinced we're going to see that.
Yeah, it's interesting, isn't it? The whole yield curves, across the board seem to be moving up at the moment. And then you have the US having to fill up those treasury coffers. I was reading overnight from the Wall Street Journal that in the short term there could be about 430 billion that they need to go to market for. Do you think that as well is going to act as a brake on markets as we see a withdrawal of liquidity out of the system?
Yeah, I mean, there is always the potential for that, but that was spoken a lot about in the last few weeks, to be quite honest. When these debt ceiling negotiations were happening and when people were talking about default, there was a lot of conversations happening of, well, it's not just default. In fact, default wasn't really ever a risk, right? I mean, no one ever thought the US was going to default on its debt, but it was about what was going to come next as a result of those that increased borrowing. Was it going to act, as you say, as a drain on liquidity? I'm always a little bit skeptical with things like this because I think yes, you can see that kind of drain on liquidity, but that's where the kind of higher yields come into play. I always feel like in situations like this, it's not necessarily we're going to see liquidity pulled from other corners of the market per se. We're talking about hugely valuable investments here. What we could typically see in the shorter term in situations like this is higher yields being offered in the US because they know they have to entice investors ultimately back in. Now, that was very different going back when interest rates were closer to 0% than where they are. But I think I'm not necessarily convinced by the idea that we're seeing necessarily money pull out of different areas like AI in order to be, because we're seeing this net dash for liquidity, I guess, in the US. I think as you guys alluded to earlier in the show, I think with AI we've seen such an enormous run up. And almost on its own, if you look at other corners of the market, we were seeing this massive run up in AI stocks, but other areas weren't following it. And the reason is because people were still quite pessimistic on the economy as a whole. AI was a very individual story. And now that we've seen the market spooked again by, like I say, these rate hike stories, then I think we have just seen simply a little bit of profit taking. I wouldn't be surprised if we see AI back in fashion again really quite soon, to be quite honest.
Interesting. So, I mean, I guess there's, at least judging by the Australian rates curve, and I'm sure it's, a story that could be told right across the globe is that, well, the higher we hike, the quicker we'll eventually cut because of the eventual recession that'll have to come from that. I mean, are you seeing signs or perhaps think that a thematic here is, these concerns of a pretty significant slowdown, especially as it relates to corporate earnings?
So I think earnings have remained resilient up until this point. But I do see a point in terms of what central banks were trying to avoid from the very start was having to raise rates aggressively enough that it's going to ultimately damage the economy. I think central banks always want to do so slowly so that they can achieve their mandate of getting price pressures back towards 2% or thereabouts while remaining resilient on the economic front. And the issue that they've now got is that they're reaching a point where, and you're seeing this talked about a lot more, are central banks going to have to crash the economy in order to achieve their mandate? Because price pressures are so stubborn. I mean, we take here in the UK, last month, the Bank of England seemed to be very confident that we were going to see inflation fall considerably, and it would be like the first step towards going back to a much more reasonable level. And we did see inflation fall, but it didn't fall nearly as far as they expected. In fact, core inflation increased by another 0.6%. So these stubborn price pressures mean that the central banks have to do more. And I think we are now reaching a tipping point where central banks may soon have to decide. We're not quite there yet, but central banks may soon have to decide, are we going to have to crash the economy in order to do this? And I think it's that nerves, that anxiety that filters through at times that is going to be a more influential role in these markets over the next couple of months. I think there's a lot more data to come over the next couple of months, which could look a lot more favourable and could change that narrative. But if it doesn't, then I think central banks have a really hard question on their hands.
Absolutely, Craig. Well, we're certainly down here in Australia getting comparisons, some of our numbers to 2008. So not that one wants to be a harbinger of doom. The people are starting to talk that way. But look, thank you so much for joining us on The Close this afternoon. Great conversation and insights.
Thank you.
COB, sorry.
Okay, well, let's get to the leaders and the laggards. Starting with the leaders, and like we said before, it's those big moves in coal that has caught some people's attention. Now, it has to be said that Whitehaven was once upon a time, and not so long ago, up above $10 a share, so it is in a bit of a downtrend, but it has bounced. So I would imagine that's following the futures prices in terms of Newcastle coal futures. I haven't checked that myself. Hard to find a sort of pin and narrative on that, I guess. But we have seen, I guess, a little bit of a rebound anyway, maybe even a rotation back into some of those more cyclical moves.
Absolutely, and you started to see it in the US, and it's just continued on here. And of course, that narrative, the market's almost, trying to push Beijing into stimulating the Chinese economy more than what they've currently done in terms of getting the larger banks to drop their deposit rates by 15 basis points.
Yeah, most definitely. And I think we actually had a chat with Kerry Craig from JP Morgan today. If anyone is interested on that story about how, there's been this kind of, surplus of hope and a deficit of action when it comes to China's economy and its reopening, that being unwound. Like we said before, computer share, interest rate sensitive story. Beach Energy has been selling off recently on a variety of more company specific news, but that's a little bit of a bounce after yesterday's sell off. Let's get to the laggards now, because we spoke about the retailers, we spoke about tech. A few tech names, Polynovo pulling back. That was a ripper of a run.
Yep.
I think it was yesterday or the day before.
Yep.
I remember, had that surge.
And Imugene continuing to be sold down, as well as Boral. I think there might have been a broker change on that one. I just can't recall exactly. But of course, Boral is very heavily exposed to what some people might, look at as the building sector, very cyclical, it's going to be hit, etc. And Xero, of course, in the line of fire there, down 5.75%.
Yeah, it was up around $112 at the start of the week, and now down on not a couple of days in a row, then certainly a few days this week, and sustained now. We're back at around $105. Paring back some of those gains that were achieved after the company last reported. Broadly speaking, doesn't really show up there, but again, the retailers are amongst the laggards. Yeah. There's actually some pretty significant sell-off selling going on there. If it weren't for maybe some of our bigger names in the market, perhaps you could dare say the day's trade might have been a little worse than this. But let's get to the smalls now and see what we can find. The small cap is, let's have a look there. Avita Medical up 11%.
Resources Dev up 8%. Service Stream, we don't hear of that very often these days, do we? Up 7%. Didn't they used to have the Telstra contract? Am I getting confused? Yeah.
I'm not too sure. I just thought SodaStream all of a sudden, mostly because it's really hot in here. I'm rather thirsty, but certainly no association with that. Baby Bunting down again. We spoke about stacks, right? It was a 40% cut in guidance. That has to be reflected, especially when, actually you were talking about this with Roger, multiples start to get really compressed when sentiment sours.
Yeah.
So you get the double whammy of earnings downgrades,
really
but also multiples going...
Absolutely. That really is in the line of fire. And Nuix too being sold down 9%.
Okay, so there are some of the smalls. Let's get to...
Just have to pick you up on smalls, because the Brits, when they talk about their smalls...
Their knickers?
Yeah. So we're not talking about the underwear in the market.
Yeah, if there's anyone in the UK right now, you haven't tuned into sort of Ausbiz After Dark. That's small cats we're talking about there. That comes later on. But let's get to some of the data coming up this evening, the After Dark tonight. US jobless claims really...
That'll be interesting to see, actually, because that has been ticking up.
Yeah, it is trending higher really slowly. And it's, I think, it's sort of cliche, but we talk in cliches because it's easier to understand. That whole notion of things happening very slowly and then very quickly all of a sudden.
Yeah.
And I think jobless claims is a great example of that.
Absolutely.
Yeah. So I think that the forecast is for 236, but it's throwing a dart at a dartboard sometimes with those forecasts. But here's tomorrow, and this could be interesting because I didn't want to preempt the conversation when you were talking about China stimulus before. But PPI and CPI tomorrow really interesting because they're going through what can only be said as really disinflation, if not
Correct.
deflation.
And that whole narrative is coming up again. Literally, is China going to start to, export disinflation or deflation? So that will be very, very interesting.
Yeah, and whether it wants to as well, because my whole argument has got its own domestic financial concerns and financial stability risks that maybe it wants to stay back on the stimulus until the Fed breaks the back of inflation in the US, and then they can start from scratch themselves when things are a little less risky from a financial stability front when we're in a recession and rates get cut back to who knows where. But that's a story for another day. Hopefully it doesn't materialise, I guess. But here's the close.
The close. Yep, down 0.3%, 0.32%, which, all things being considered with how much negative news is out there, well, really is not too bad.
It's not too bad. US futures are off very slightly.
Yeah.
So we'll see if there's some follow through from that sell-off on Wall Street last night, which was again very much driven by the Nasdaq and some of the air coming out of the AI trade. It's been a negative week overall, obviously, for the market. So I dare say it's unlikely that we're going to pull ourselves back into positive territory tomorrow to round out the week in terms of redeeming this week. But you never know. Crazier things have happened, of course.
Absolutely. Just looking at the Aussie dollar, it's up 0.15% at 66.6 US cents.
There you go. Okay, well, we had a lot of good conversations today, so you can catch up on those on the website and app. But otherwise, Danny, I can call it a day.
That's it. Yep, absolutely.
Have a lovely night. We'll see you tomorrow morning.
Bye.
The COB is brought to you by eToro. Invest in ASX shares with $0 commission.